What is short selling? Short selling is a high-risk, speculative strategy that many investors use to bet on a stock's decline in price. In this video, we'll take a closer look at what short selling is and how it works. Short selling is a market speculation strategy where an investor borrows shares of a stock with the intention of selling them, with the hope of buying them back later at a lower price. The difference between the price at which the shares were sold and the price at which they are repurchased is the profit made by the short seller. Let's consider an example to understand how short selling works. An investor believes that the stock price of XYZ Inc. is overvalued and is due for a correction. The investor contacts a broker to borrow 100 shares of XYZ Inc. from a stockholder. The investor then sells the borrowed shares for $50 each, receiving $5,000. The stock price of XYZ Inc. drops to $40 per share. The investor buys 100 shares back for $4,000 and returns them to the stockholder who had originally loaned the shares. The investor has made a profit of $1,000, $5,000 to $4,000, which is the difference between the price at which the shares were sold and the price at which they were repurchased. However, if the stock price of XYZ Inc. goes up instead of down, the short seller could potentially suffer significant losses. For example, if the stock price increases to $60, the investor would have to buy the shares back for $6,000, resulting in a loss of $1,000. It's important to note that short selling is a speculative strategy that carries significant risks and is not suitable for all investors. Please keep in mind that investing in the stock market always carries some level of risk, and short selling is a particularly high-risk strategy. Before engaging in this type of trading, it is vital to fully comprehend the mechanics of short selling and the associated risks. Thanks for watching.